Have you ever moved your own hard-earned money around and thought absolutely nothing of it? Paint this picture in your mind. You just sold that old camper van collecting dust in the driveway and walked into the bank with a thick envelope of cash. Or perhaps you wired a generous chunk of your savings to help your grandson cover the down payment on his very first home. It is your money, after all. You worked hard for it. You already paid your taxes on it years back, and you should be free to move it any way you choose. But what happens when a completely innocent everyday banking decision accidentally triggers a massive IRS alarm? If the idea of opening an unexpected letter from the IRS makes your stomach sink, you are absolutely not alone, and your anxiety is completely understandable. Here is the truth. Today, banking software is becoming far more sophisticated, and the IRS is watching everyday transactions more carefully than ever before. Things that passed by completely unnoticed a decade ago are now triggering automatic warning flags. But please do not let that worry you, because we are going to tackle all of that together right now. I am going to walk you through 7 specific bank account moves that draw IRS attention and, more importantly, precisely how you can steer clear of every single one of them. Hello, everyone, and welcome back to KinSmart Finance. I am Kim, and I am truly happy you decided to join me today. My mission on this channel is straightforward. I want to help you navigate your retirement journey and protect the nest egg you spent a lifetime building, completely free of confusing financial industry language. We are simply going to have an honest, relaxed conversation about keeping your money secure and staying off the tax man's radar. So, pour yourself a warm cup of your favorite beverage, settle in somewhere comfortable, and let us jump right into these 7 banking pitfalls you absolutely need to know about today. Let us start with move number 1. I like to call this the flying under the radar cash deposit. Picture this scenario. You finally decide to part ways with that fishing boat you have owned for years, or perhaps a reliable used vehicle, and the buyer counts out $12,000 in crisp cash right into your hands. You feel great, but then the bank visit crosses your mind. You may have heard somewhere that banks are required to complete extra paperwork for any cash deposit exceeding $10,000. So, an idea pops into your head. To spare the teller the extra work and keep everything uncomplicated, you decide to put $6,000 in on Tuesday and deposit the remaining $6,000 on Friday. Harmless enough, right? Absolutely wrong. Making that choice is actually one of the biggest red flags you could possibly wave. By deliberately splitting your deposits to stay beneath that $10,000 threshold, you have just engaged in what the federal government officially labels as structuring. Even if your motivations were completely innocent, from the perspective of the IRS and your bank, structuring looks exactly like an attempt to conceal something suspicious. And here is the part that catches most people off guard. Modern banking software is extraordinarily sophisticated. It is specifically designed to automatically detect these divided deposits. The instant the system identifies those 2 $6,000 transactions, it flags your entire account for suspicious activity, and suddenly you have ended up on the IRS radar for absolutely no legitimate reason. So here is my practical tip for you. Stop trying to stay below the radar. When you have a large sum of legitimate cash from selling a vehicle or clearing out a storage unit, walk straight into your bank with total confidence and deposit the entire $12,000 in one single visit. Yes, the teller will complete a document called a currency transaction report. Allow them to do exactly that. It is a completely standard part of their daily routine. It only requires a few additional minutes, and it is not a tax filing. It simply informs the government of the source of the cash. As long as the money is legitimately yours, you have absolutely nothing to stress about. Transparency is always your strongest defense against IRS attention. Keep it straightforward, do it all in one trip, and you will rest easy that night. Let us continue with number 2, which I call the generous grandparent pitfall. Consider this situation. Your granddaughter has just found her absolute dream starter home, but she is running a bit short on the down payment. You have the savings available, so you happily send $25,000 directly into her checking account to bridge the gap. It feels like a genuinely heartwarming family gesture. You are simply giving your grandchild a meaningful head start in life. So naturally, the IRS and tax paperwork are nowhere near the top of your mind. But here is the important 2026 reality check you really need to understand. The IRS enforces very firm rules about transferring your money, even when it stays within your own family. For the year 2026, the annual gift tax exclusion sits at exactly $19,000 per recipient. That means you can give any individual up to $19,000 with absolutely no conditions attached. However, the moment you transfer that $25,000 from your savings account directly into your granddaughter's account, you have officially stepped across the IRS boundary line. Now please take a slow, steady breath, because here is the reassuring tip that will ease your concern right away. Crossing that $19,000 threshold absolutely does not mean you owe any taxes. It simply requires you to submit a basic piece of paperwork known as Form 709 when you file your annual taxes. The reason is straightforward. In 2026, you also benefit from an enormous $15 million lifetime exemption. Unless you have gifted away a total of $15 million throughout your entire lifetime, you will not owe a single dollar in federal gift taxes. You simply need to report the transfer. And here is the ultimate insider strategy. If you are married, you and your spouse can take advantage of something called gift splitting. By pooling your individual annual exclusions together, the two of you can collectively give your grandchild up to $38,000 completely tax-free and without any complications whatsoever. So go right ahead and be as generous as your heart desires. Just remember to follow the required paperwork guidelines. Now let us discuss move number 3. I call this the 60-day IRA rollover stumble. Imagine you are comfortably settling into retirement and you decide the time has come to switch financial institutions or move your retirement savings to a different bank. You request a check from your existing traditional IRA and they mail it directly to your home address. You take that check, deposit it straight into your personal checking account, and tell yourself you will forward it along to the new broker next month once everything calms down a little. It seems completely harmless, right? After all, it is your own retirement savings, and you are simply holding onto it temporarily for a few weeks while you get your new account sorted out. But here is why the IRS pays close attention and why this particular move is genuinely dangerous. The moment you personally take possession of those retirement funds, an extremely unforgiving countdown begins immediately. The IRS allows you precisely 60 days to deposit those funds into a new qualified retirement account. And let me be crystal clear, they have absolutely no sympathy for delayed mail deliveries, packed holiday schedules, or extended vacation trips. If you miss that rigid deadline by even one single day, the IRS classifies the entire withdrawal amount as a substantial taxable distribution. Suddenly, your carefully accumulated retirement nest egg is slapped with a significant income tax obligation. And if you happen to be younger than 59 and a half years old, a 10% early withdrawal penalty gets added directly on top of that bill. So here is my protective tip for you. Embrace the power of the direct transfer. The completely foolproof solution is to simply never allow those retirement dollars to land in your personal checking account at all. When you decide to move your IRA funds, reach out to your new broker directly and ask them to initiate what is officially called a direct rollover. This is a straightforward institution-to-institution transfer. The money travels directly from your previous financial institution to your new one without ever passing through your personal hands. When you handle things this way, there is no 60-day countdown ticking away, no complicated tax withholding to manage, and absolutely zero possibility of missing a stressful IRS deadline. It is genuinely the safest and most effortless way to relocate your wealth. Let us continue with number 4, what I personally like to describe as the payment app confusion trap. Plenty of folks are discovering enjoyable side hustles during retirement to bring in a little extra spending money. Perhaps you are finally cleaning out the attic and listing those gorgeous vintage collectibles for sale online. Or maybe you are offering a few hours of freelance consulting each week, and your clients are sending payments directly through apps like Venmo or PayPal. It is so fast and effortless that you probably just watch the money appear on your phone screen and never give it a second thought. But accepting payments through these platforms can create a genuine headache once tax season arrives. Here's the important reality check for 2026, and I really want to help clarify this because the rules have been something of a moving target lately. For this particular tax year, the IRS requirement for receiving that dreaded 1099K tax form from payment platforms has generally returned to $20,000 and 200 separate transactions. That sounds like a reasonably comfortable cushion, does it not? But wait, because here is the absolutely critical exception. If someone pays you directly through a conventional credit card or debit card processor, there is essentially no minimum threshold at all. You could potentially receive a complicated tax document for a single transaction worth just $10. So here is my practical tip for keeping everything clean and simple. You absolutely must separate your business payments from your personal ones. Please stop using that exact same Venmo or PayPal account to collect your consulting income and to split the dinner tab with close friends. When you combine everything into one account, the platform has no ability to distinguish between taxable business revenue and your friend reimbursing you for a shared pizza. If you accidentally reach those reporting thresholds, the IRS might receive a form implying you earned thousands of dollars in taxable income when a large portion of it was simply everyday expense sharing between friends. The simplest possible fix is to create a completely separate dedicated payment account used exclusively for your side business activities. It keeps your personal financial life entirely private, prevents any IRS confusion, and transforms tax preparation into an absolute breeze. Let us talk about move number 5, which I call the snowbird foreign account oversight. So many retirees fantasize about the beloved snowbird lifestyle. Visualize this. You finally purchase a charming little condo down in Mexico, or perhaps a peaceful summer retreat in Europe to escape the brutal winter temperatures back home. To simplify daily life, you open a basic local bank account over there simply to handle the automatic payment of your electricity, water, and monthly community association fees. It is not a sophisticated investment portfolio. It is purely a practical convenience account to keep the utilities running smoothly while you relax and soak up the warm sunshine. But here is precisely why the IRS keeps a watchful eye on even that modest little convenience account. The United States enforces a very strict $10,000 aggregate rule. If the combined total balance of every foreign bank account you hold reaches $10,000 at any single point during the calendar year, You are legally obligated to file an FBAR, that stands for Foreign Bank and Financial Accounts Report. The IRS aggressively pursues undisclosed offshore funds, and unfortunately, they remain completely indifferent to whether your account simply holds money for utility payments. Claiming that you simply forgot or were unaware of the regulation is an excuse the IRS will flatly reject every single time. So, here is my essential tip for staying completely out of trouble. You must make routine balance monitoring a standard part of your regular schedule. Keep close watch on the peak balance sitting in that foreign account throughout the entire year, paying particular attention to periods immediately following a large transfer you make to handle your seasonal living costs. Remember, the rule applies to the highest balance at any given moment throughout the year, not merely the balance sitting in the account on the final day of December. I want to emphasize this point with absolute clarity. Even if that foreign checking account generates absolutely zero interest income whatsoever, you are still completely obligated to report it if you reach that $10,000 threshold at any point. Completing the required filing takes only a few minutes online, but doing so will shield you from genuinely shocking financial penalties and allow you to enjoy your international getaway with complete peace of mind. Let us move forward to number 6, the overlooked RMD transfer. If you are currently in your 70s, you are well aware that reaching age 73 introduces a significant new financial obligation known as required minimum distributions, or RMDs. Picture this scenario. It is late December and you are completely consumed with holiday preparations, buying presents for the grandchildren, and welcoming family members who have come to visit. Amid all that joyful holiday activity, it is remarkably easy to simply overlook moving the required funds out of your traditional IRA and into your regular bank account before the firm December 31st cutoff date. It may feel like a minor oversight, but it carries an extremely costly consequence. Here is why the IRS takes this matter so seriously. You have to remember that the government has patiently waited for decades to finally collect taxes on that money. They extended you a tax advantage when you made your original contributions, and now the waiting period has officially concluded. The IRS knows precisely how much money you have accumulated inside those tax-deferred retirement accounts. Neglecting to take the exact required withdrawal immediately triggers an automatic warning flag inside their computer systems. They will not simply send you a polite reminder notice. Instead, they will impose a steep 25% excise tax penalty calculated on the precise amount you failed to withdraw. So here is my tip for eliminating this stress from your life completely. You need to place your RMDs on total autopilot. Do not depend on a handwritten sticky note or a calendar alert that you might accidentally overlook during a hectic week. Instead, contact your brokerage firm today and establish an automatic scheduled transfer arrangement. I strongly recommend having them automatically move your required distribution amount directly into your personal checking account every single year during early November, well ahead of the holiday season even getting underway. Most brokerage firms will enthusiastically calculate the precise required withdrawal amount for you, handle the appropriate tax withholding, and execute the transfer without any involvement from you whatsoever. When the entire process happens automatically in the background, you will never lose a moment of sleep worrying about missing an IRS deadline or facing a substantial financial penalty again. Let us wrap everything up with number 7, a very familiar mistake I encounter constantly. I describe this one as mixing side hustle income with personal checking. Running an enjoyable side hustle during retirement is absolutely wonderful. Perhaps you are finally getting compensated for your extraordinary woodworking craftsmanship, providing part-time tutoring sessions, or picking up a handful of consulting projects. A satisfied client hands you a payment check, and naturally you head straight to the bank and deposit it right into your primary checking account. It sits comfortably alongside your regular Social Security deposits and your monthly pension payment. Keeping every dollar in one convenient location just feels so much simpler, right? But here is precisely why the IRS pays attention and why this seemingly innocent habit can evolve into a full-blown audit nightmare. When you combine your business earnings with your personal retirement income, financial professionals refer to this as commingling funds. If you are ever selected for an audit, the IRS examiner has the complete legal authority to review every single transaction recorded in that account. Because absolutely everything is blended together, the auditor may examine every individual deposit and assume it all represents taxable business revenue until you can demonstrate otherwise. Suddenly, you find yourself spending countless hours trying to prove that a birthday gift from your sister was never actually a consulting payment. So here is my essential tip for protecting yourself and preserving your peace of mind. You need to build yourself a free business checking shield. Give yourself one clear action item this week. Visit your local bank or credit union and establish a completely separate, entirely free checking account dedicated exclusively to your side business activities. Every dollar you earn from your woodworking projects or tutoring sessions flows directly into this new account, and every business-related purchase comes straight out of it as well. By taking this single step, you instantly create an invisible protective barrier. If the IRS ever raises questions about your business income, you simply provide the statements for that one dedicated account alone. Your personal grocery purchases, medical appointments, and family gift transactions remain completely private and safely beyond their reach. It is the most straightforward possible approach to keeping your retirement both peaceful and well organized. Let us take just a brief moment to summarize everything we have walked through today. Moving your hard-earned retirement money around absolutely does not need to feel like a frightening or overwhelming experience as long as you have a solid understanding of the fundamental ground rules. The single most important lesson from our conversation today is that transparency and straightforward organization are genuinely a retiree's most powerful allies. When you maintain separate accounts, rely on direct transfers, and file the standard required paperwork, you effectively keep the IRS entirely out of your everyday financial life. Now, I would genuinely love to hear directly from you. Which of these 7 banking moves caught you most off guard today? Have you ever come dangerously close to falling into that stressful 60-day IRA rollover trap we discussed earlier? Or were you completely caught by surprise discovering the 2026 gift tax thresholds that apply when helping your grandchildren financially? Please share your thoughts down in the comment section below. I personally read every single response, and I truly enjoy hearing your individual experiences and responding to your questions. If you found these banking tips genuinely useful today and you want to keep protecting your retirement savings from unnecessary taxes and penalties, please go ahead and tap that like button. It makes a real difference in helping our community expand. And please remember to subscribe to Kim Smart Finance so you never miss straightforward, everyday financial guidance. My consistent goal is always to make retirement planning feel manageable and completely stress-free for you. Thank you so very much for sharing a portion of your day with me today.